If you or your loved ones have a disability or have recently been through a significant personal injury or illness, this video is going to step you through the financial supports available for you. This is the financial support pyramid. At the base of the pyramid is the National Disability Insurance Scheme, which provides eligible participants with funding to improve their quality of life. It could be for assistive technology, home modifications, or therapy purposes. It's at the base of the pyramid because the National Disability Insurance Scheme is not means tested, meaning you or your family's income or assets are not assessed when determining whether you're eligible. It's also at the base of the pyramid because you can still work and receive the NDIS, unlike other payments. Disability support pension is means tested and requires you to be unable to work for more than 15 hours per week. The disability support pension is a fortnightly income payment designed to pay for the basics of life, such as food, accommodation, and utilities bills. The disability support pension can be quite a strict criteria, and I'll give you an example. Many years ago, I had a client who had multiple sclerosis and was able to claim on their TPD insurance policy, but was not able to claim on disability support pension because the severity of their condition was not serious enough yet to get DSP. DSP criteria is more closely aligned to not being able to do the activities of daily living, which is usually the 5 most important activities of daily living, such as being able to feed yourself, shower, and dress yourself. In combination, the NDIS and DSP round out the government supports available to you. And most people can manage these payments themselves or with the assistance of other family members. As financial planners, we come in above the line, helping people with their personal insurance claims, personal injury compensation proceeds, and sometimes setting up special disability trusts. Many people have insurances within their superannuation even if they're not aware that they have them. Many super funds will offer default life insurance, total and permanent disability insurance, and some will also offer income protection insurance. However, they won't offer trauma insurance inside superannuation. That's a type of insurance that you actually have to go and sort out yourself. Total and permanent disability insurance is where 2 doctors sign off that you're unlikely or unable to ever work in your own occupation or any occupation for which you're reasonably suited, trained, or have experience in. The different terminology I've used there depends on which type of policy you have. TPD is a lump sum payment, and therefore it's harder to claim on than, for instance, income protection, which pays a monthly benefit for as long as you need up until the benefit period goes to after you've served the waiting period. Let me take a second here to say, if you're still fit and healthy, please go and see a financial planner to get all of your life insurances organised. The difference between having a comprehensive life insurance package where you're fully protected versus just the default cover inside most people's superannuation can be enormous and have real outcomes in terms of your quality of life going forward. If you've developed a disability which could lead to a TPD claim, it's imperative that you go and see a financial advisor for advice. If you take the TPD claim from super as a lump sum, you could pay a tax of 22% on the taxable component. And the assets that are now in your bank account could lead to a lower disability support pension payment, as you could be negatively affected by the asset and income test. By contrast, a financial planner can help guide you on how to maximize your disability support payments, minimize your tax, and create a plan for what to do with the proceeds, whether that's paying off your mortgage, leaving some money in super, investing some funds, or whatever the best outcome may be for you. Personal injury compensation is only available when someone else is at fault for your injury or when there's a compensation scheme in place. So for instance, for road accidents, it doesn't cover any illnesses that you may develop. Commonly, no win, no fee lawyers will help clients in this area to work out a settlement amount. However, where we come in is in terms of a plan for what to do with these settlement proceeds. So it could be paying down debt, investing the proceeds, and also working how this fits in with the payments such as disability support pension, because often there'll be a preclusion period put in place against DSP for certain personal injury compensations. Special disability trusts are at the tip of the pyramid because you need to have enough money to make these trusts worthwhile relative to the annual running costs of these trusts. A common example of when these trusts are used are when parents put money into these trusts for their children, whether they're kids or their adult children, for their long-term benefit. The three main benefits of a special disability trust are asset protection, tax minimisation, and different asset test and gifting exemptions. A common asset protection benefit of these trusts is, let's say the parents are getting on in years and they want to make sure that their disabled adult child is going to be financially supported well into the future, even past their death. They could set up this trust and then nominate a sibling of the disabled child to be the trustee and manage the investments on their behalf well into the future and when the parents are not around. As financial planners, we can also help the trustees manage those investments and allocate the income. There are two significant tax benefits of these trusts. Typically, the assets that go into these trusts are capital gains tax free. Secondly, these trusts can then offer the children adult tax rates. Remember that kids are taxed at the maximum 47% on income above $1,307 per year. So by getting adult tax rates, they can earn $18,200 tax-free in this trust, and they're not penalised as significantly as the income in the trust goes up through the marginal tax rate system. Let's say those parents are pension age and eligible for the pension. They can gift up to $500,000 to this trust, and that won't be assessed as a gift for their own age pension, which means they could receive a higher benefit amount. Secondly, around $800,000 can be transferred into this trust, and that can be a non-assessable asset for disability support pension for that disabled beneficiary. To wrap up, your financial circumstances and the manner of your disability or injury determine which of these financial supports you could receive or utilise. It is theoretically possible to be able to receive all 5 of these financial supports if, for instance, you incurred a personal injury and you had the proceeds to also do a special disability trust. I would encourage anyone with a TPD payment, a personal injury compensation payment, or who could utilise a special disability trust to reach out. If it's something that I can't help you with, there's a range of different professionals from estate planning lawyers to personal injury lawyers and accountants who can also help in this area, and I can put you in contact. Lastly, the blog post that I'm referencing on the screen here can be found in the link in my bio. So if you need help, please reach out.